joined by the best-looking man in value investing, the George Clooney of value
I'll
investing.
keep it coming.
Oh, the youngest value investor I know.
Ah,
We're usually all old guys.
there's no one left. How are you, fellas?
Welcome.
Thanks. That's a very kind
Yeah,
introduction.
good. Oh man, every time I see you, I'm like, how does he get to be so good looking? That's not fair.
It's an app.
You're sporting a little bit more grey, a little bit more grey than the last time we talked, which was a couple of years ago, I think.
Yeah, it's that deep
Is that-
value will do it to you.
I thought it was Trump's tariffs that were doing it to you.
I don't even follow the news anymore. Just switched it all off.
So Tobias Carlisle from the Acquirers Fund, the Acquirers Dilemma. No, what was the name of your book?
Yeah, the last book was The Acquirers Multiple that came out in 2017. And the firm is Acquirers Funds. I've got two funds. They're both ETFs listed on the NYSE. ZIG, which is mid and large, deep value, domestic US, and DEEP, which is small and micro, deep value, domestic US.
Were they Zig and Zag? No, just Zig.
I've got somebody to put their foot on Zag for me, but I don't have a Zag fund. I probably would like to do an international or a global fund, but I've got to digest the two that I have. I need a little bit of a tailwind, I think, before I really launch another fund.
So how's the funds going?
They're doing fine in their category, but their category is getting smashed. It's the curse of the deep value. It's like all value, all strategies have their cycles, and this has been a very long one against value. Depending on how you measure it, it starts in like 2010 or 11 or 15, and looked like there was a little bit of a bounce after 2020, but that AI news, just crucified us since like the beginning of 24, and it's been a little bit miserable since then. But I think that the values continue. It's funny because it's just multiple compression because the values tend to be quite good. I think the companies are getting healthier and healthier and looking better and better. It feels to me like the early 2000s, like after following the late 1990s, which was a very growthy, large cap market, and it really left all of the small value stuff behind and the rest of the world behind. And then at some point that cycle changed. I think probably it needs a crash to turn around, but I'd be happy for it to happen without a crash, I can tell you.
It was like the late 90s to me. All the AI stocks and the Mag 7 stocks have been going up on forecasts and predictions, basically.
And that, the what do they call it? The quantum computing. Like there's no, the market caps on those things are like $7 or $8 billion. And they don't do anything. They don't even have a product. It's pretty impressive. I saw, that OpenAI, it's got like 100, OpenAI is a real business. Like I think they're probably still losing money, but it is a real business. People pay for that, that little window, that ChatGPT. And, whether it can justify a $100 billion valuation or not, I don't know. But it's good news for Johnny Ive, who was the bloke who, he made the iPhone or one of those. I think he was the iPhone kind of designer for Apple. And then he spun out and he's created this consultancy. Like they don't have a product or anything like that. They just consult. And OpenAI has picked them up for $6.5 billion, which is good work if you can get it.
And it was started, Love From,
That's
his
it.
consultancy was started last year. Just got it picked up. And Johnny wasn't part of the deal.
Is he not?
He's going to work for IO, the new company that's come out of the merging of OpenAI and Love From, as a consulting advisor or something. But yeah, from $0 to $6.5 billion in a year. Not just the iPhone. I mean, Johnny was the guy, sorry, Apple fanboy here. Johnny was the guy behind the iPod, the iPhone, the iPad, the Macs, the original Lolly Macs, and when Steve came back, and then the MacBooks and everything cool that Apple did in that period when Steve was alive was Johnny as leading the design team. So he is, he stole it all from Braun, but all of the ideas from Braun, but it modernized it. So like he's a genuine
credit where it's due.
design
He's
From Bauhaus.
guru. Yeah.
he's good at his
Yeah.
job. But I like the fact that their first product's like this hockey puck. There's no screen, and it's basically Alexa. I don't get it.
Well, they haven't actually said exactly what it is. All they've said so far is what it's not.
Okay.
It won't have a screen. Yeah, it's not a phone. But I think the assumption is, because the rumors for the last couple of years since he and Sam Altman have been working together, is they're going to come out with a AI native phone to go up against the iPhone. But,
It'll have
anyway,
it'll have rounded
yes.
square edges, like which was his
It'll
contribution
look
to
beautiful.
the iPhone.
It'll look
Yeah.
beautiful.
I'm just marking up my AI bingo card here, Tobias.
I've said all of the keywords. This
was
should
a
rank
quick,
quite high. This podcast.
It was well, Cam does the futuristic podcast, and we last about 5 minutes when we start talking about shares before AI comes up. So, well done.
I'm a big fan of AI. I mean, I was a little bit skeptical initially because it was pretty middling, but I think that I've got better at using it, and it's probably got better along the way as well. And I think that I can see, it does replace it's going to be tough for people to get a foothold in any industry, because it's like having a pretty competent MBA doing your research. It's not all, you have to check it and you have to make sure that it's right, but it's often a pretty good starting point for whatever project you're working on. So I think it's good stuff.
Does it get to replace all of us? What's your prediction?
I still think that, like anything, you need ultimately someone at the very top of the output, making sure that it makes sense, because it does sometimes it's 180 degrees wrong. It doesn't know what it's talking about, and it also has this. I think that the problem with using it for writing, I think I can recognize AI writing when I see it. It has this particular. It's almost like, it's a little bit like poetry. Like, it doesn't quite make sense, but if you just let it wash over you, you kind of get the general gist of what they're trying to say. Right. It's like reading some.
It's
like
the vibe.
T.S. Eliot or something like that. Yeah, it gives you the vibe rather than any sort of detail.
Well, I had an interesting discussion yesterday with a veteran fund manager at lunch, and we were talking about quant filters, and he said his experience was they need at least one experienced person as the overlay, as a qual overlay, because sometimes the figures just need questioning. They don't make sense. And if you're an AI or you're a filter, you don't pick up the fact that this could be fraud or something funny's going on here.
I think that there's a real problem with the data. The data is, it misses. It can be up by a factor, because it's sometimes the data is just entered in millions or thousands, and it's just totally wrong from that perspective. So it's just finding something that, it's 1/100th of the price. But if you get the decimal point in the right place, then it's overvalued by a factor of 10 or something like that. That happens a lot. I do think that if you get good data and you have a more sophisticated program that's looking at a few different things, that they're pretty competent, and I think they pull up some interesting ideas, but there is always that risk of an outlier that makes no sense, that any competent human being would look at it and recognize it immediately.
Well, I think also too, eventually you're going to have an AI for a CFO who's going to try and gain the quant AIs who are checking the
that already
sheet,
happens. Right? That certainly already happens.
Right.
I think if you read Amazon's letters or Amazon stuff, I think that they're putting that through a quant filter, because I'm aware of some firms that look at the tone of the letters and the tone of earnings calls, and there's some really interesting stuff out there. One guy was telling me that they can detect depression in a CEO by the number of times that they use I and it's undetectable to the human ear, because the difference is like 4% in ordinary conversation or 6% in, like, for it to become pathological, which is tiny and you can't hear it. But where it starts trending up like that, it sort of sets off all these alarms that there might be something going on that they haven't sort of really disclosed yet, or doesn't need to be disclosed, when in actual fact there is something there. But the companies themselves are now aware of this, and they're putting it through the reverse filter to make sure that they're not getting caught out on that stuff.
The CEO's train, yeah. They do makeup, they do presentation skills, and then they do eye contact skills.
It's a long way from that Enron where I think that's still a red flag if there's swearing on the so that might rule out a lot of Australian companies, I think.
Yeah. Hey, I wanted to just pick up something you said about the cycles of deep value, because Might be, I don't know if it's different in the American market or the Australian market, but there's certainly cycles in the stuff we do, but we tend to still do well through all kinds of cycles. So it might be a definitional thing. I mean, our big driver is price to operating cash flow less than 7. That's probably how we define value. But it doesn't always perform evenly, but it kind of performs all the way through cycles. Do you have a different experience in the States?
I think that I'm talking about relative performance, and I think the thing that distinguishes the US market from really the rest of the world is they do have those very big, fan mag, bagman, fang, fan, whatever the current, bag of letters is for describing them. And those companies really do drive the index. And they are very big companies, but they're also very good companies. They've got excellent returns on invested capital, but they tend to be pretty expensive. They're often nosebleed valuations for those things. So they're very rarely through my filters, although they have on occasion popped up. So Meta popped up, when they were having the problems with when Zuck had decided that everybody was going to be welded into the metaverse with him and we were all going to crash in the volcano. And it was like $12 billion a year in spending on servers or something like that. They changed the name from Facebook to Metaverse. That's how committed he was to this thing. And I think everybody just got scared because free cash flow fell off a cliff. But then it's still qualified as cheap because I use the acquirer's multiple, which is enterprise value to operating income. It's just the accounting variation of cash flow that you're identifying. And then I have various other filters to look for. I want to see earnings converting into cash flow. I want to see management doing something sensible with it, reinvesting in the business at pretty good rates of return, or buying back stock, or even doing acquisitions if that's, if they make sense. And I just measure the performance of all of that reinvestment over an extended period of time. And if those things are good, then it's a good position. It's just that on a relative basis, it's hard against some of those stocks like NVIDIA. So, FANG, Netflix quietly got dropped as the N, and NVIDIA became the N in some of those definitions. And NVIDIA's had a pretty good run over the last few years. And just on a relative basis, it hasn't been as strong. I think that I tend to invest in heavy metal, heavier industries. So that currently I've got a big exposure to oil and gas, which a lot of value guys these days, more modern value guys avoid because oil is a commodity. It's totally unpredictable. It could be up or down next year. And the attitude towards oil and all the oil conferences and all the reports that I see are incredibly bearish for oil, even though it is at $60 for WTI. They're calling that supply destruction, which honestly I was a little bit surprised about because in my mind, from about 5 years ago, $60 was a pretty good price. Like $60, $65 was, a lot of them were making money at that level, but there's just been this inflation that everybody's seen everywhere, and that's impacted the oil and gas companies in the States as well. So break even is now like $90, which is an extraordinarily high price. So at $60, they can't make any money, and all of the high cost guys are burning cash or leaving. So there's a portion of my fund dependent on oil and gas, which I think it's a good bet because they're cheap, and I favor the ones that are currently cash flowing and doing something about, with good acreage. But there's a little bit of, it's subject to what the oil price does over the next 12 months or few years.
Yeah, I came out of the oil industry back in the 80s and 90s. And so I keep an eye on it. And a very high level model for the oil market that seems to work for the last 10 years or so since Russia got involved with OPEC Plus is that as the oil price rises, it's like holding a sponge between two fingers, right? The oil price rises, the shale oil guys in the States go, beauty, we can make money. They come back on stream, and then Russia and OPEC close the pincers on the sponge again, and then they all go into dormancy for a while. So it's really controlled by Russia at the moment, with the oil guys in the States having their day in the sun when the barrel price rises for a while, but it's very cyclical in that tight range.
In 2021, we had $150 oil. Well, we've come back pretty considerably since then in 2025, and it's been just downhill basically since then. So we're at the lower end of the range here. And I think supply destruction is a good thing. And I have a basket to get to 20% of the fund. I have a basket of holdings. So some of them are cash flowing really well at this level, and some of them are a little bit more marginal, for the reason that if the price goes up, the marginal ones move a little bit more than the ones that are doing well at this level. But there's always a risk that the marginal ones can't survive. So I favour the ones that have got a healthier balance sheet and so on. There's a little bit of speculation in it. I think it's an intelligent speculation, but it's, it remains to be seen.
Yeah, fair enough. Yeah. Yes. Sort of adjacent to the oil industry, we did a show last week on Ford. We're seeing some value on some parts of the car industry. Is that something you're seeing as well?
I think cars are tough. So about a month ago, I was in Shanghai and I was looking at some of the tech. Shanghai's kind of interesting because the Chinese have got high tech. So we visited some high tech VCs, hard tech as they call it. And the hard tech VCs are working on autonomous driving, robotics and AI, which I was sort of a little bit surprised about that. I would have thought maybe fusion or something like that was hard tech, but the stuff that they're working on is probably what you'd expect that they're working on. And while they said that they're not quite where America is, they still think that Tesla is ahead in robotics, which I was a little bit surprised by. And OpenAI is ahead in AI, but they say that, OpenAI is expensive, whereas their technology, which was DeepSeek, I think is 95% of the way there, but like 5% of the cost. And I think that where that really shows up is in the consumer tech, where they have cars there. So Huawei is a maker of cars there. Huawei make TVs and phones and everything. And we went into one of their display areas and had a look at a couple of their cars. They've got these gorgeous looking cars, like leather interior, screens all through the entire thing. They're EV. They charge. I think I said charge in 5 minutes on my podcast, but I think it might be charge in 15 minutes with the tech coming to charge in 5. And then the cost of those is $35,000 US. Like there's nothing in the States for $35,000 US. The only thing that's going to save Tesla and other companies like that in the US is if they can't import them, which, that's currently the case. They're not able to get into the States. But I think what that means for some of the auto OEMs in Europe and the US is that they're going to have to do something pretty unusual here to kind of, I don't understand why they've got two choices really. They either cannibalize themselves and do it, or they just go out of business. So I think auto OEMs are tough. What are you seeing?
Well, when we did Cameron did a deep dive on Ford, and they're basically, they spent $5 billion on their EVs, and they're basically trying to shut them down now. They're lobbying the government to change the incentives, and they're going back to ICE production. What do they call it? The skateboard, the F-150 chassis that they put everything else onto, is their business model going forward. And that might work as long as the US has cheap oil. That's going to work. Because that's the biggest thing that hits me when I go to the States is you can fill your car up for about a quarter of what you can in Australia. So it's a completely different market, really.
Is that including in California? California feels expensive to me when I travel around the States.
Yeah, okay. Yeah, true. No, I'm thinking about Florida and the East Coast.
I just think even more than the cost.
I think
Sorry, Ken.
Oh, I was going to say our approach to analyzing these sorts of businesses is we don't tend to get bogged down in future forecasting, predicting the future with these things. We look at where they're at today, and Ford's truck division is generating tons of cash still. They're blowing it all on the EVs. They're bleeding with the EV division. But they're, as Tony said, they're sort of pulling back from that quite a bit at the moment. But they're still generating tons of cash, and the price to operating cash flow metric is really quite low. So we tend to look at, what's their cash flow like? What can we get them at? And we let the future sort of worry about itself. We aren't buy and hold forever value investors. If something breaches one of our sell triggers a year from now, we're happy to sell it and replace it with something else. So we just look at what we can get today that seems to be a good business, core fundamentals of it, without trying to, look into a crystal ball. What's that line? Those who live by the crystal ball will eat shattered glass, I think.
That's a good one.
Ray or one of those guys,
Yeah.
one of those old time guys said that. And that's what Tony's drilled into me over the last 5 or 6 years we've been doing the show, is that don't try and predict the future. Just look at what's really generating cash today. It has a track record of generating cash, over a little while.
You put a quality overlay on it to make sure the business is going to be around, like a lot of debt. It's been around for a long time, throwing off cash. It's got good management, all that kind of thing. The question mark, I guess, on forwards management, it's been a bit rocky over the years, but, it's been around for a long time too. So it's not about to go broke.
I don't think the US can let those companies go out of business either. I think they need them for defense and just for other reasons. But I think it's a tough competitive landscape globally. But I'm with you on I look at the current performance of the businesses and tend to buy them on that basis too. I don't look too far into the future for the reason that I don't think you can tell. You don't know what's going to happen.
Can I ask you about China before we move on? I read Thomas Friedman's article in the New York Times a few weeks ago. He went to Huawei's technology park. Did you go to that? He said it's like the size of 10 Disneylands, and it's just lab after lab after factory after factory. Of the way he sold it, it was like Futureland. Did you get to see any of that?
No, that's not what we did. We just rode bikes down the river, and we had a local guy there who would just say, 3 months ago, this was a cement factory, and now it's this like gorgeous kind of shopping center precinct with, lots of high-end shops inside. And we walked into one to have dinner. And then as we were walking out on the ground floor, there was a big Huawei showroom. And the showroom was like half a football field, but I think it's just their ordinary. It was just one of them. Like, there could have been a few others nearby.
Right. And so what's your take on China after your trip and where they're at, where they're going? We often laugh. The Australian media is constantly talking about how China's about to implode, China's economy is screwed, China's massive debt crisis or real estate crisis or this crisis or that crisis. And it just seems to be the never-ending China's about to fall over narrative. What's your take on it after being there?
Some of those global macro type things are a little bit beyond my pay grade, but I can tell you that just walking around, it looks very wealthy. It looks very prosperous. And speaking to people, and this is in Shanghai, which is like their New York, it's their Manhattan. So it's a concentration of wealthy, ambitious people, but people are very, very ambitious. They talk about 6-9, which is they work 6 days a week from 6 to 9. And they're going to grind really hard and make a lot of money and improve their lives. And everything there is like pretty reasonably priced. You can get an apartment not that far from downtown for like $1 million and it's brand new, which is, that's unimaginable in New York for sure. And you can buy, pretty good, the problem with coffee in the States for a long time was that it was just garbage. Like it was all that Starbucks type coffee. But there has been an improvement. I can find some good coffee places here now. And China's similarly, there were lots of good coffee places, but the coffee's like $2. Where I am, it's like 6 to 8. And it was great coffee. And they're knocking them out really quickly. I felt like everything was a little bit better than in the States and considerably cheaper. And that was, the cars are just the best example of that. I think they are a little bit better and they're like half the price.
Yeah.
But not about to go broke.
Hard to tell. If maybe there's massive stimulus going on and I'm just not aware of that, but I don't see them going broke. They look to me, I think there's a reasonable chance that it's like the US at the turn of the century or something like that, where everybody was like, business minded and ambitious and prepared to work hard to improve their lot. And I think that's what they're doing. And I think they'll probably succeed. They're smart. They work hard. Like those things help.
Your comment about not understanding the macro side of it reminds me of that interview you did with Rich Zenner recently, which I thought was terrific interview. We stole a couple of quotes from it and talked about it on our show. But I think at one point towards the end of it, he said, I don't understand macroeconomics. Don't try to. It's never been my thing. People ask me about Bitcoin. I say, I don't understand it. I like that. It was great to hear a guy with that sort of pedigree just say, yeah, you don't need, or he doesn't even try to understand things that are beyond his remit. He just focuses on the businesses and looks at.
You got to respect him. Like he really does. He likes investing, and so he started. The firm's got his name on it. He started it, and he ran it for a very long time. And he's decided that he doesn't want to do any of the stuff that he doesn't want to do anymore. So he's handed over management and marketing, all that other stuff to everybody else. And all he does now is pick stocks because that's what he wants to do.
Mm-hmm.
And yeah, so
that's what he loves.
He knows, ignore the macro. What do they say? Ignore the macro and just find the best biscuit maker in Bemidji or whatever it is. Like, that's all you need to do.
Yeah, that's very much our focus as well, isn't it, Tony? That's
Absolutely.
what Tony drills into us, is just ignore the noise and look for businesses that seem to be well run that you can buy at a discount for some reason.
Well, there are. I mean, my experience, Tobias, is that there aren't that many macroeconomists who are billionaires, right? Maybe George Soros. But
you got one trade right once.
Yeah, if they were that good, they'd rule the world, but they don't. So they might be good at Rear Window telling you why it happened, but they're terrible at predicting what comes next.
And I similarly like Druckenmiller, who was a protege of Soros and was the one who came up with the idea for the trade that broke the Bank of England. And Soros's part of that was just make it bigger. If you're this sure, let's make it 10 times bigger.
Yeah, right.
But I like listening to Druck because Druck says all of this stuff that I agree with. And then, he says he's got these trades on, and then they talk to him a year later and he says, yeah, I changed my mind. I reversed all those trades. I went and I made money. So I don't know.
Yeah. No, it's good. And like you just said something important, and you listen to some macroeconomist guy because you agree with him. And that's what it is. It's almost like politics these days. You've got Friedman on one side and someone on the right on the other side, and people just listen to the economics they want to hear.
That's right. There's a lot of that.
Mm.
And then you've also got guys out there like Tepper. Like Tepper got that balls to the wall trade right, like 2012 or something like that. He said the Fed's told you what they're going to do. They're going to print, so just get max long, and that worked out really well for him. And then he did it again recently where he said he was max long China. And then he was selling in the aftermath of that, where everybody took him at his word, I guess, and was, maybe they were getting longer, but he was distributing it out to them as they bought long. So I don't know if you can necessarily listen to, there are very few people who are investors who I would listen to. And I mean, I would not trade on what anybody said necessarily, but, maybe Buffett would be the only one who he gets long. But even then, if you look at Berkshire Hathaway's trades, if they'd come out in their 13F, they have lots of positions that they trade in and out of, which maybe that's the boys trading through the insurance companies or something like that. But even Berkshire is not as buy and hold as it looks like on the label.
No, they've held on to the things which have done well, and they've gotten either the bad trades have quietly gone to zero, or they've got none of them.
That's the trick, I think, isn't it? You just hold your winners forever and quietly sell the losers.
Mm-hmm. Yeah, and then people say, "Oh, you buy and hold," but like they've held about four positions.
That's it.
Yeah. Do you want to talk a little bit about Warren's retirement and what Warren means to value investing from your perspective?
Yeah, I'm a fan of Warren's. I started investing because a friend of mine in university said to me, there's a bloke who runs an insurance, the richest bloke in the world runs an insurance company. So I just tuned out as soon as he said that. And then he said, but he writes these letters that explain what he does as an investor. So I thought, that's interesting. I'll go and read them. And it made sense when I read them. I think people talk about that. Either they make sense or they don't. Plenty of people are just like, I don't want to take this long to get rich. And other people are like, well, at least this is like there's some scientific process to this that you can apply. And
that's
then
why Bitcoin exists, right? The people who don't get
that's
Buffett,
right.
Don't want to take time to get rich.
That's right.
The anti-Buffett.
Yeah.
But it's worked well for those guys too, so I can't be too critical of those guys. And then I think someone said, there's something about drinking, I forget the analogy that they made, but they equated it to drinking scotch, where people start out drinking, whatever, some pretty ordinary blend, and then they become more into it and they drink these more exotic things like Isle of Islay, all of the Frags and all the really peaty ones. Then they go back to things that are just more easy to drink. They call it this like U-shape appreciation. And I think it's the same thing with Buffett. Like, everybody knows that Buffett's wealthy and a good investor, and so they start with Buffett. And then they just kind of discard those ideas over the years as they think they know better. And then after you've been doing it for a while and you've had some hide taken off and you've got some scars, then you go, I've done this plenty of times, thought that I've come up with something new and gone back and read Buffett from 1983 and realized he'd already come up with that idea. And then he explains the 3 reasons why it doesn't work. Like, oh, okay, that's good. In 1983, I could have saved myself the trouble. So the things that I like, he has this kind of scientific approach. He recognizes that you're really your own worst enemy. It's so easy to follow a hot trend or to get scared out of something because the very next print or the stock price direction isn't the one that you want. And if you've done enough work and nothing's changed, then you really shouldn't be changing your mind that quickly. And the final thing that he does that I love, which is I think he genuinely is honest. Like, he's trying to do it the right way. And I remember reading that Lowenstein book, The Making of an American Capitalist, when I was just in early university. And it made me feel positive that you probably could do it in a pretty honest, you didn't have to be kind of cutthroat to succeed. And I thought so I thought those things were good. And I think the fact that he's been as influential as he has and he's sort of promoted those values has been good for society, good for business in general. Very sad to see him stand down, but 95, that's a pretty good knock.
Yeah.
60 years in the seat is a pretty good knock.
Yeah. I mean, I agree with everything you said. He and Charlie are my heroes. I'd probably add a couple of other things. I'd add that he's a very good marketer. I think that's probably his apart from his investing skills, that's his next biggest skill. So he always comes out in his annual reports and tells you what he did wrong that year right off the bat. So, which
that's
really
uncommon.
good.
There are lots of folks who don't do that. That doesn't make you necessarily a good marketer, just like saying that you're...
Oh, I think it is.
But I do think that he is a good marketer.
Take your worst thing and market the hell out of it, right? Because it's going to be a cat. Everything else sells itself.
I see. Yeah, that makes sense. That might be where I'm going wrong.
You look at any political party, they'll spend most of their time talking about the most controversial thing, right? Because everything else their followers are going to believe. So but he also says things like, well, tune out the noise, and I live in Omaha to keep away from Wall Street. And then you read about him. He's on the Washington Post board. He's in New York with this guy and that person. He's the biggest networker under the sun.
He's phenomenally sophisticated. He's very, very sophisticated. When he talks about like the derivatives one is one that always everybody says, well, he wrote all of this stuff about derivatives being weapons of mass destruction, and then he turns around and sells this giant put on the index. How is that any different? But it's different because he got the cash up front. He got to hold on to the cash. And then, he had this idea about where the index was going to be in 10 years' time. And it was a very modest hurdle for him to get over. And he could invest that cash at the same time. And if he can outperform, then it makes total sense to do it. As it happens, he didn't have to pay out on it anyway. So he just got free use of the cash. Pretty clever.
Yeah. I mean, he makes the point that if he had borrowed against Berkshire Hathaway shares along the way, he would have been broke twice. So a pretty strong argument against derivatives too.
Do you think that Musk has some pretty significant borrowings against Tesla shares?
I couldn't say. I don't follow. It's like the antithesis of what Warren teaches. So
it just reminded me. I'm sort of curious about Tesla. I watch Tesla from a distance, and it's very well known. Musk is very well known. It's in the news all the time, so it's hard to avoid. But it's one of those stocks that to me, it just completely defies everything that I've ever learned about investing. And the fact that it has remained so resilient for so long. And you can talk to people who are devotees, and they have this similar attitude to Musk and Tesla, probably as we do to Buffett and to Berkshire. So it's just a curious thing. And I think that he does have some borrowings against his his shareholding. And I've always thought there's a reasonable chance that there's a smoking crater at the end of the Tesla journey, but not yet.
Well, I think his big advantage is Robin Denham, the Australian chair of the company. Whenever he needs money, he just ups his options, his remuneration.
Well, I thought another sneaky way of doing it might be if he sells XAI or X, whatever that conglomerate is now called, into Tesla, which I think the Tesla shareholders are quite willing to entertain that proposition, and he's valuing that at like 100 billion or something like that. So he'll do well there too if that happens.
I went past a Tesla in a car park recently, and it had a sticker on it saying "Bought before Doge."
Yeah, I have one.
I see he came
Sorry,
out
Ken.
today and was making some disparaging comments about the one big beautiful bill,
Yeah.
and how it was Doge was supposed to be helping reduce deficits, and it's going to increase the deficit by 4 trillion or whatever it is. So interesting to see where his relationship with the president is going to go in the next few months.
I think he's stepped back, hasn't he? I think it's already happened.
Well, he says he has, but it's his team that is still running Doge, all of the guys that he put in there. So I'm not sure exactly to what degree his involvement is out. I think he had to say something to sort of stop the bleeding from Tesla's share price.
He's
I
certainly
mean,
got
Tesla
some
said,
influence still on the White House, given the reception the South African president had there in the last week. The white genocide.
Yeah, I saw the presentation. Yeah, I saw what happened.
So, Tobias, we've started paying more attention to the US market now. I started a US portfolio about 18 months ago. It's doing quite well. It was doing a lot better before Trump's tariffs, but it's still doing okay. But there's two things I wanted to ask you about. One is about your prognostications on where the US economy is going, if you have any. And secondly, when you talk about benchmarking your fund, you seem to be comparing it to the FANGs or the AI stocks or whatever, instead of against something like the S&P 500. Is that right? How do you measure your respective performance? Is it against the top end of town or just the median?
Yeah, so I would be measured properly against a basket of stocks that is more comparable to the universe that I'm investing from, which would be Russell 1000 for ZIG, Russell 2000 for Deep, and then really Russell 1000 value is the appropriate benchmark and Russell 2000 value. But that's like intellectually that's the truth. That's what I should be measured against, and that's the place to be. That's what I should be compared to. But realistically, S&P 500 is an option for people, and so are an even further concentration in there into the Mag 7 or something like that. So you can't ignore those things completely. But I don't care too much about either of those things, because I'm trying to, ultimately I want to find things that are going to survive whatever happens over the next, few years. And I don't have any particular view about the US economy's strengths or otherwise. I think that there's lots of things that you could point to and say these are scary. They've got huge debt. That's a problem at some point, although it doesn't seem to have been a problem yet. And so maybe it never is a problem. And there are all of these little like macroeconomic indicators that are variously up or down. Or I think that the picture is, you can make an argument either way, that the US is a very strong economy, stock market's very expensive, justifiably so, or it's weakening and it's turning and it's too expensive and it should come down quite a lot. I don't know which one of those play out. I think that whatever happens, I just want to be in things that are cash flowing pretty well, pretty healthy balance sheets, and doing something with those cash flows. So if we go into something like, if we are in fact in the early 2000s and the index goes sideways, I think folks might have forgotten this, but the index went sideways from 2000 to 2015, and there were two pretty big drops through that period of time. So it's entirely possible that happens again. If you're in that kind of market, you want to be in deep value, because the deep value stuff, value has traditionally worked by you buy something that's undervalued, and you get a little bit of mean reversion. So it tends to go back to the average valuation or closer to what its average valuation should be, as whatever bad thing sort of passes on. And then you're selling out of that more expensive stock now and rebuying something cheaper. And that sort of ratchet effect of buying and selling from expensive to cheap and so on can generate performance when the stock market is drifting sideways, which is what I think happened in the 2000s. It's happened repeatedly since the stock market, 1850 or 1825, wherever you can get the data going back to. It's not uncommon. And there's equally the growthy techie cycles have been, they've happened many times too. There've been at least 6. The original one was the first information boom was the telegraph. And they laid a subsea cable from London to New York so they could do gold arbitrage between the two. And the first transportation revolution was the steamships. So they could move goods and things around a little bit faster than they had previously. Everything was, information and products traveled as fast as the wind blew from London to New York and back again. And every single time that that's happened, it's been bad for value and great for growth. But then once the market sort of assimilates all that information, once having a .com is not merely enough to pump your stock price up, and you need to actually, the .com is table stakes now. Every company's got a .com. So I think that the same thing happens. AI, there's a little bit of excitement, but eventually every company's going to have an AI strategy, whether it's dealing with customers or embedded in their product. When that happens, the market will just assimilate that information. We'll go back to normal. We'll go back to buying on a financial basis. So it becomes more of a financial cycle. And that's when you see the reemergence of the private equity guys and that sort of stuff. I think that we're probably getting close to something like that happening. And that's a good place. That's a good thing for deep value, because that's exactly what deep value is, just buying purely on the financials rather than on the story that attaches to the stock.
Yeah, I think you made a lot of good points there, and not the least of which was the market can go up, it can come down, it can go sideways. And as long as you have a framework for dealing with each of those, it doesn't matter which way it goes, really. And I think deep value value is the framework for that. It always has been the framework for that. I mean, the only other thing I'd throw into the mix that you didn't mention is passive investing. So we're seeing it on the ASX in stocks, well, particularly Commonwealth Bank, which is now the world's most expensive bank on, most metrics. But it's, good old private, publicly owned New South Wales government owned, pretty basic vanilla bank, selling mortgages and taking deposits. And yet it's and they normally trade on low double-digit PEs. It's like double that now, at least. And it's all because index funds, it becomes a hamster wheel. Index funds buy Commonwealth Bank because it's the biggest share in the market, which drives up the price, which means index funds buy Commonwealth Bank because it's the biggest share in the market. A lot of that's going on in the US now. I mean, I've seen analysis which says it's something like, I forget now what it is. The US is well over half of the US index is now well over half of the internationally focused holdings for passive investing. And then the Mag 7's share of that is like 30 or 40%. So it's, as soon as the speed bump gets hit and those passive funds flow out, and the hamster wheel stops, that's when it's going to be a problem, I think.
There's a theory that floats around here promoted by Michael Green, who that's basically his theory, that this passive investors are price insensitive because it's purely based on float adjusted market capitalization. And so the biggest companies with the most float out there attract the lion's share of the flows, and everything else is kind of left behind. And he says that the end result of that is that all of the price sensitive buyers leave the market. And so you've only got these passive funds competing with each other, and eventually prices go to infinity and then collapse to zero. I don't know if we quite get to that point, but I think that we've seen this before, though. I think that every single market looks like this. Every single market is good for big, growthy companies. And that's exactly what happened in the late 1990s. everybody thinks of it as a dot-com boom because that was sort of that was the new flavor at the time. But really, it was companies like Walmart was very, very big. GE was too big. Microsoft was massive, and they remained very, very good businesses from 2000 to 2015. But the stock prices went nowhere because they were just too expensive at the beginning. Even though under the hood they were sort of still growing earnings at like 15 or 20% a year, they were compounding away as businesses. But the stock prices were going nowhere, and that was a better market for value. I don't know that it is this passive flow that will always dictate it. It seems to me that if these passive flows are pushing at one part of the market and pulling down another part, or this other part isn't participating, shouldn't that mean that there are bargains there for value investors to pick up? And if if a company is, you don't need necessarily multiple expansion to make money in a business. If the business is buying back stock, the multiple can stay flat and the underlying business can do quite well on a per share basis, and that's how your performance is measured. So I think that there's lots of, and I particularly like those kind of companies where they're really good cash flows, the management is smart, and they buy back stock at opportune times. And my portfolio tends to be filled up with companies that are pretty good repurchases of stock. And that's been if you look at something like AutoZone or O'Reilly, those are companies that there's been this, they sell goods for cars, basically. They sell like parts for cars for people who are DIY, like you want to clean, you get some armor all, or you change your own bits and pieces in your car. And the thesis has been, well, EVs are going to come in, nobody's going to need these pieces anymore, all these businesses are going to die. But they're still opening up hundreds of locations, these businesses. They're still cash flowing really well. And because they're cheap, they buy back stock. And the stocks have performed phenomenally well for long periods of time. And so I like that model where that's an understandable model. It's a pretty simple business. There are lots of these little simple businesses around that do that. And I think they'll do well, even if they don't get the multiple expansion, simply because you're just getting that value concentrated in whatever stock remains. So I think that there are ways to outperform, even though there's a little bit of multiple compression sort of going against you until the market turns. And when it turns, then, value will have a good 10 or 15 years, hopefully, as it has in the past.
Yeah, when the tide goes out, we see his ring naked. But question for you about buybacks, because this is one of the differences between the Australian market and the US market is we have franking credits. So is a company buying back shares equivalent to a company paying a good dividend yield in Australia? Well, you've got experience in both.
Yeah, that's a good question. You would prefer probably just to get the dividends. If you can get, if the Australian system is great because that franking credits make you're totally, I was going to say ambivalent, but you don't really care which way. If you get the flows as dividends, they're not double taxed. Here it's a different story. They are double taxed. And so all else being equal, you probably want the company buying back stock. The problem here is that they have introduced this 1%, that's not really much. That's basically brokerage on. But there is a 1% tax on buybacks, which is either the thin end of the wedge, so they can jack that up over time, or it's a little irritant. I think it's not the end of the world, but it's definitely they have to pay that. It's brokerage, I guess, but it's an irritant. I would prefer that it wasn't there.
There, apart from the size and liquidity of the market, what other differences do you encounter running a fund in the US compared to how it might happen in Australia? I mean, I'm talking about quarterly reporting, regulatories, different classes of shares. What else do you need to be aware of?
I hate those different classes of shares. That's something you encounter pretty frequently over here. Like Google is owned by three blokes. That's Sergey Brin, Larry Page, and Eric Schmidt. And everybody else has got non-voting stock. Even there's two classes of stock that are publicly traded that neither of them vote. And so you're just participating with whatever those guys do, which, that's suboptimal. It would probably be better to have a little bit more external pressure, particularly given the nature of that business, which is like information heavy and everybody's got a Gmail account. So they probably know everything that everybody's doing. They're not subject to, any oversight, and they've got whoever their CEO is it Sundar?
Sundar.
He's out there, he's a human shield, and you got a few 100 million to be a human shield. It's probably a job I'd do, honestly, but it's not that same situations you have in Australia where there's only ordinary shares. There's no second class of shares, which I think is a good thing. The reporting is interesting because I've worked in a company that had to report in Australia, and there's a lot of work in reporting, even half yearly. I don't know how they do it in the States. I mean, it would take you a quarter to put together your report, so you just spend the entire quarter putting together your report, and then so your entire business is just reporting. You don't actually ever get around to running the business. But as an investor, I like having quarterly reports so I can see what's happening. So that is a little bit of a difference. The other thing is there's market makers here. There's no market makers in Australia, so you stick your trade in the screen, and it gets somebody on the other side picks it up or they don't. Here, the market maker can enter in and cause the trades to occur, which is a strange kind of hangover from a previous time. I don't think you would necessarily need a market maker. I don't know how that impacts the market, but it's something that I'm always aware of. And also the prime brokerage, there's much more. That prime brokerage is standard here. That used to be, nobody ever knew what that was until the GFC came along, and they had all those companies that had the rehypothecation of shares that they'd lent out to somebody else who they didn't own them, and then when they collapsed, you go to the broker asking for your stock, and they've already lent that out, and it's somebody else has got that stock. That's the standard here. In Australia, you tend to hold the stock yourself, and it's unusual to find prime brokerage. I don't know that they really make much difference. Any of that stuff makes much difference to the way that the market runs. Like, there's plenty of tiny companies here that just never ever trade by appointment, just as there are in Australia. There's plenty of big companies that plenty of liquidity and they trade all the time. I always think it's funny looking at, some days Tesla trades more than SPY, which I find just bizarre.
Yeah, right. And what about regulatory requirements? So for your podcast, for example, do you have to hold the equivalent of an AFSL license to talk about shares?
Yeah, so I have a license. I have a Series 65, Series 7, something like that. I forget which. I might have both or one or the other. I forget which one I have. And I have that to manage the funds. But I'm very careful not to mention the funds on my podcast. And as long as I do that, I'm okay. But if I start talking about my funds, then I have to put all of my podcasts through compliance, which would be a nightmare, which would mean that I'd have to approve an hour of me talking about them every week. Yeah, so you don't need the AFSL for the podcast, but I do need it for the funds, the equivalent of the AFSL.
Yeah, okay. Yeah, interesting. I think that was my questions. Cam, do you have anything more to go through?
No, I think we're coming up on an hour anyway. We've taken enough of your time, Toby. So thanks for sharing that. And I guess my last question really is, do you have an exit plan if the US ends up in a civil war? How are you getting out? Because one of my sons moved to LA a couple of months ago, and it's what he and I spend a lot of time talking about is if shit goes down, how do you get out? Do you have a submarine or something like that ready to go?
I think that it's like a little bit like being in China relative to what the rest of the world reports on. There's really, I go outside, the sun's shining, I walk the kids to school. It's not a bad life where I live. And I don't really encounter anybody who's, there's the political view in California is one thing, go to Texas, it's a different way. But I don't think that the fighting will be state by state or anything like that. Like it would break along very funny lines. I don't think a civil war is a real possibility.
It's interesting, isn't it? Every time I go to America, the people are really friendly and I get on well with them. And per trip, I might encounter one or two idiots, but they're easily managed. But like in Australia, I get in the car and I encounter one or two on the first street. So it's a pretty civil place in the US.
Americans, I think that Americans are great businessmen because they have this attitude that they really do assume positive intent in most things that people say. And I think Australians, like we like to joke around a little bit. We're sort of teasing, that's kind of the Australian personality. Like, you never really give a straight answer to anything. And I think Americans are very earnest. They take they take our teasing a little bit literally sometimes. So I think that could create a little bit of tension. But now that I'm sort of aware of that, I have fewer of my little Australianisms, and I try to just answer the question directly for the most part. And, it's been fine.
They don't get satire, do they? Because they take it all literally.
I think
my wife
to give them it is a positive thing. It's not that they don't get it. It's just that they're assuming positive intent.
Yeah.
Sorry, Cam.
My wife's American. No, sorry, as I said, my wife's American, and it took her, I think, 10 years living here before she got accustomed to people taking the piss, and that it was a sign that they like you. They wouldn't take the piss if they didn't like you. It's a sign of affection, not a sign of aggression.
They trust you to get the
Took
joke.
a long time.
I trust you to get the joke. And if you're taking me at face value, then that it's revealing something about the way that you think that I think, which is I've had a lot of time to think about this stuff because I've had to navigate it both ways.
Yeah, right.
Yeah.
Well, I'm glad to hear your accent hasn't changed. I've been listening to your podcast in preparation for this discussion, and after about 5 minutes of the first one I listened to, I thought this is like a cartoon, like a Disney cartoon. All these different American accents, but then it's contrasted against what I would call a normal accent, an Australian accent. You sound like the adult in the room talking to Daffy Duck and Mickey Mouse when you're on the podcast.
That's funny. Yeah, I don't consciously do anything, but I have heard other countries say in Australia that I'm easier to understand in Australia than other Australians, but it's not anything conscious that I'm doing other than you can't walk up to someone and say g'day like that. You can't open the conversation with g'day because they're not looking for that. They're looking for hi or hello or something like that. It's just little things. It's just weird little cultural things like that.
Yeah. Very good.
All right. Thanks for chatting with us, Tobias.
Thanks for having
Appreciate
me.
Oh, before you go, for our American listeners, if they want to check out the fund, where do they go?
Zig and Deep. Go to your brokerage account, type in Zig, type in Deep. Check out acquirersmultiple.com. Check out Acquirers Multiple in Amazon. And I'm working on a new book. I've almost got the first draft finished, so that'll be out hopefully sometime in the next few months, I think. I've just finished the first draft. I've got to go back and read it and make sure I haven't gone insane, that it sort of makes sense. But I feel pretty good about this as it stands at the moment.
Is this an investing book or is it about how to be good looking? Oh, okay. So it's
I've got a filter. That's how you get a good filter.
An avatar.
You can't trust you could be AI as for all I know.
It.
What's the premise of the new book? Can you tell us a bit about it?
Yeah, so I've called it Soldier of Fortune at the moment, and it is the ancient art of risk-taking using Sun Tzu and Warren Buffett. It's a gamble. People are either going to think that I'm nuts, or hopefully they'll get it and they'll enjoy it. It's supposed to be a pretty lighthearted read. I've used 3 of Buffett's lesser known but transformative deals and some of the motivations that he has for doing these things that were a little bit of a departure from what he has traditionally done. And then I just try to discuss what that reveals about his strategy beyond sort of just trying to buy things that are undervalued or things that are like the wonderful companies at a fair price. They're just trying to reveal a little bit more of the strategy. That's the idea.
Terrific. Well, when it comes out, you'll have to come back on and we can talk about the
And you have to wear camo. You can be a soldier of fortune and an eye patch.
Yeah, that's the only concern. I'm no soldier. I'm no warrior. I'm a lover, not a fighter.
All right. Well, thanks again, and look forward to having you on in a few months when the book comes out and we can get our head around it. That'll be great.
Thanks, fellas.
Love a good Warren Buffett story.
I appreciate it.
Thanks, Tobias.
Thanks for having me.
Tobias.
Cheers, mate.
Okay. Bye.